Hey everyone, I'm David Finz, and on this episode of the Cyber Insurance Imperative, we're taking the pulse of the market. A recently released report from S&P Global indicates that the exponential growth of the cyber product that we have seen over the past few years has started to level off, and that could be good news for policyholders. Overall, direct written premiums fell slightly in 2023, dropping 0.7% from the prior year, but still coming in at just over $7 billion. Standalone policies registered a 3.2% decline, while the smaller market for package policies grew by 5.1%. S&P Global also noted that amidst stabilizing prices, direct loss ratios inched up slightly from 43.1% to 43.6%. But these figures are still well below the results we saw in 2020 and 2021, where loss ratios were around 70%. This is significant because the underwriters need to keep those loss ratios under 60 or at most 65% to continue to offer this coverage profitably. The picture gets even clearer when we drill down to individual carriers. 8 of the top 10 insurers for standalone cyber coverage clocked in with loss ratios of under 60%, and 9 of the top 10 were under 65%. Only one had a less profitable loss ratio than that, and that particular insurer has continued to shrink their book year over year. Now, we continue to hear quite a bit of talk about emerging threats, and I certainly don't want to minimize those. The good news is that S&P is reporting that insurers are not expecting to see large losses from the attack on Change Healthcare, an incident which has had a ripple effect on 189,000 entities, according to the risk analytics firm CyberCube. However, this attack did underscore the vulnerability posed by third-party risks, and more particularly the service providers that cater to a large swath of a particular industry, such as healthcare. As CFC Underwriting acknowledged in its comments on the report from S&P Global, underwriters are still grappling with how to address the exposure presented by so many insureds using the same handful of vendors, a danger known to insurance geeks as risk aggregation. One thing is sure for our clients: getting a handle on your third party and even fourth party exposures is going to be critical for managing cyber risk, both in terms of presenting a compelling story to the underwriters as well as to reduce the likelihood and potential impact of an attack. Vendor management is about good contract wording, but it's also about independent audits of your service providers, as well as making sure that you have contingency plans in place if one of your key service providers is taken down by a ransomware attack or other cyber event. This is where the Alliant Cyber Practice can help. Our risk consultants can help you develop a TPRM solution that anticipates those issues and enables you to present your risk in the best possible light to the underwriters. Want to learn more? Please don't hesitate to reach out. You can DM me on LinkedIn or email me at david.finz@alliant.com, and I'll be happy to put you in touch with our cyber risk consulting team. The stabilizing market is also a great time to make sure that your coverage remains fit for purpose. With so much emphasis on pricing over the past few years, broadening your coverage seemed like something to put on the back burner. But now, with a stabilizing market, your business may have more options. And now is the time to take a fresh look at your policy wording and make sure that it is stayed current with the threat environment and the needs of your business. I can review your current policy and let you know where there may be room for improvement. And if your current broker isn't having these conversations with you, maybe it's time that you discover the more rewarding way to manage risk. Thanks for watching.